Hello, everybody. Thank you very much. Let's start this panel on the staking economy. My name's Michael Gauckler. I'm Chief Product Officer at Bitcoin Suisse and hosting together with these wonderful panel participants. Eva, you want to start your introduction?
Let's try this, much better. Hi everyone, my name's Eva Lawrence. I am the head of EMEA for Figment. We are the complete institutional staking provider. We help hedge funds, asset managers, custodians, banks, you name it, put together a staking strategy for non-custodial protocol staking and execute on that strategy. I have been in crypto now for 4.5, 5 years. And prior to that, I worked at Morgan Stanley as an equities finance trader.
Thank you, Eva. Robert?
Hello, everyone. My name's Robert Ellison. I work for Allnodes. Similar to Figment, we run staking, proof-of-stake staking specifically. We run about 33,000 nodes on the network across about 65 proof-of-stake protocols. My background is in crypto, in encryption, and working with protocols, probably, I don't even know how long, over a decade. We focus a lot on retail, and we're growing out our institutional capabilities as well.
Cool, thank you, Robert. Just to make it very clear what we're talking about, we want to start with our understanding and definition of staking. Robert, you want to continue there? What are we talking about?
Sure. Really important, because it's in the news, as everyone's probably aware. Staking is a term used all over crypto, and I think it's important to be quite specific on what it actually means. I often pinch myself because it's in the name, proof of stake, right? It's essential for how protocols on proof of stake networks work. What that means is, as a token holder, as having ownership of part of the network, the security of that network depends on you staking to the protocol. And that staking, or that what's called that delegating your tokens, is non-custodial in nature typically. That means you're securing the network. What does securing the network mean? It means that you're improving the health of the networks. It means they're decentralized. It means you're attesting to blocks. And it's part of the core functionality of a proof-of-stake network like Ethereum. I could continue to sort of do some comparables, or...
It might be also good to mention the fact that in terms of the non-custodial protocol staking that we're referring to, the reward is determined by the protocol. Yes. It's not plucked from thin air. It is determined by the protocol and then passed on to the owner of the token. So that also works alongside the non-custodial element. You're not transferring the title of your tokens, and the return is passed through to you, or the institution as a token owner via the protocol.
Yeah, technically speaking, when a new block is created, when a validator like Allnodes or Figment attests to the new block on behalf of the delegator, you get a reward. You're securing the network, and in turn for that, your reward is some yield based on that transactional gas fee. And that reward is directly tied to your non-custodial wallet. So you really own it. So there's a direct relationship between sort of yourself and the blockchain. I think and the reason why there's some sort of confusion around this issue is people use the term staking all over the place. You see it in DeFi, and it's not the same thing. It's important to differentiate there. When you see some DeFi using the term staking, they're not protocol staking. What they're doing is possibly lending. They're possibly creating liquidity pools with your token. It usually works with a smart contract, but there's no actual protocol behind that functionality. There's no direct relationship with your non-custodial wallet and the protocol.
Thanks, Robert, for that very detailed explanation. We see it the same way at Bitcoin Suisse, and we see it especially important to have this definition when we design products that are robust against regulatory scrutiny. So moving on to what it is now, who's using it? Eva, can you explain, and from your experience, who has the most interest?
So I think people would be surprised about different types of institutions and how many different institutions are looking at staking. So it could be from a VC, hedge fund, asset manager that holds tokens. Perhaps they've invested in a project and they're holding tokens as part of that investment, and then they look to stake those tokens to secure the network and earn rewards. Then you have custodians, exchanges, trading platforms that want to offer staking to their underlying clients, whether that be hedge funds, asset managers, individuals. And then you have everything from banks to family offices, private wealth funds who are also looking to get into staking. I think as time goes on, as we get closer to the Shanghai upgrade, we're seeing a lot more interest from those larger institutions who want to get involved and want to prep themselves to be ready for the upgrade and look at exploring Ethereum as well as Solana, Polkadot, and other coins to stake. But I think we'll see that institutional focus and that demand increase once we have passed the upgrade, as I think for a lot of people, they're waiting for that time.
Cool, exciting times. We've covered what it is, we covered who's interested, and now let's go deep down into the rabbit hole. What's got staking and the staking economy to do with minor extractable, maximal extractable value, and the censorship discussion? Where does this come in?
Sure. So it's a bit of a rabbit hole. It's called MEV. Technically, that stands for minor extractable value. It's pretty popular, I guess. Popular not being the best word on Ethereum. It's part of now the functionality of Ethereum, but it also applies to other protocols. What it is sort of in financial terms, I think it does two really good things for users. If anyone's familiar with Wall Street and front running, where traders could basically manipulate trade orders in front of the users, this was also happening in cryptocurrency. So on Ethereum, as transactions are added to what's called the mempool, you had miners who were able to manipulate the transactions, and this is why, for example, last year you saw very exorbitant gas prices. So in order to sort of solve for that solution, you have platforms, or almost a whole new cottage industry of what are called MEV relayers. The most popular one, or the most famous one, being Flashbots. So what does Flashbots do? And now the landscape is filled with probably about 10 MEV relayers. They protect the consumer, so they protect against front running and sandwich attacks, because they basically bundle the transactions in the mempool and auction them off to the validators. So they can't manipulate the price points anymore, or the actual transactions. And then the added benefit there is the end users, the stakers, if you're staking, get increased yield because they're auctioned off to the validators at usually the highest price point. So really two positives in the MEV relayer landscape.
Thanks for the explanation. You want to add, Eva, or shall we go to the next one? Because we can see quite a rabbit hole of complexity, and sometimes things then are built layer on layer on top and are misunderstood. And then we have cases like recently SEC Kraken, and I heard earlier at the coffee machine SEC banned staking, and that's of course not true. I think it's important to understand what exactly is going on. Eva, do you want to
Sure.
comment?
So the SEC made a decision in relation to Kraken, which was not a ban, which was not a law, which was not a change in regulation, as they don't have the scope to do that in any case. But they made a settlement in relation to Kraken and their staking program offered to retail investors, in which the assets were pooled and commingled with some of Kraken's. With some of Kraken's tokens, and then Kraken were determining rewards, the rewards which were passed back to the consumer, and there was a lot of ambiguity, or in the SEC's view anyway, there was ambiguity around the fees and what those fees were. But I think this kind of comes back to the main point here, which is clarity around definitions, as we were just talking about. People throw the word staking around and they use it to refer to a whole manner of things. If I said to you, I work in mining, you'd say, well, either that's not enough information. Is it gold mining, coal, iron ore? What kind of materials do you use? How's the waste? What's done with waste after the mining process? To use the word staking and throw that around and not be precise about what you're referring to, I think is the issue that causes both confusion and bold headlines.
Well, I would say it causes instability in the marketplace as well.
Exactly. And we're very good in crypto at putting a label on things or having a nice acronym. And I think in many areas we need to be clearer about what we're talking about. And staking is definitely one of them. And for us, we are focused on non-custodial protocol staking, and that mission hasn't changed.
Yeah, I'd add to that, I think it's important to mention with the ruling against Kraken that it was very specific to not just what's called pooled staking, but specific to Kraken's management of pooled staking. And so what that ruling it won't be able to be applied in a legal sense to other platforms. It's just very, very specific. And as Eva says, sort of the sky is falling on Twitter and social media in the media. It's important to be I guess it's important for us to educate people on what staking is. This doesn't affect Allnodes' business model. We're, at the end of the day, a technology company, and Figment as well. So yeah, some clarity is needed there.
Cool, thank you for these explanations. Quickly in the middle, recap the storyline. So we defined what it is, staking, as in securing the proof-of-stake blockchains. We looked into details that there's additional rewards or work to be done with MEV. And we talked about the special case where the product of Kraken maybe wasn't built in the right way. So we have participants that want to stake. We have service providers like here on stage helping it. And now we're going another layer up. What is liquid staking? How does this fit into the picture on top of it?
So we've seen interest from institutions to be involved in staking Ethereum, as we touched upon earlier. And a number of market participants have been looking at how to provide this Ethereum staking to them without locking up the token. So obviously at the moment, as you may know, we have to have tokens locked up until the Shanghai upgrade. So a number of institutions say, okay, that's great, I want to stake my Ethereum, but I don't want those tokens to be locked up. How can I still have liquidity? So a number of market participants got together to look at an offering for institutions so that they could be able to stake without effectively having to lock up those tokens. And what we've seen in the past has been kind of an alphabet soup of what you would get in return for your Ethereum. And what we have tried to do at Figment, along with some others in the industry, is put together a consortium that have a liquid collective name bundle, I guess you could say, who are offering the token, a staked token in return. And then this token is not something that has absolutely no utility. You have a liquid market in which you can utilize that token. So I think as we come closer to the merge, we're going to continue to see more institutions interested in staking Ethereum. So hopefully looking at getting involved in Liquid Collective. I don't know if that is what you've seen as well from Bitcoin Suisse.
Yes, I think I should add that Bitcoin Suisse has announced that it will join the Liquid Collective and work together with Figment and Coinbase on launching a product that allows liquid staking using the liquid token as a collateral or to create liquidity before the unstaking is possible.
Yeah, that's fantastic. I think there's just so much potential there. What's interesting about the liquid Ethereum market specifically is, as most people probably know, Lido is sort of the lion's share of that right now. I think what the industry needs is more diversity in that landscape. So at Allnodes, we support Rocket Pool. That is a liquid token as well, but it's more retail focused, so it lowers the barrier of entry for participants. Right now, you only need 16 ETH to run up a Rocket Pool node, and soon it will only be 8 Ethereum. But if I just look at the whole industry, you know, there's going to be more liquid staking providers, and so there's just a lot of growth and opportunity there, including with Liquid Collective.
Cool, thanks for that addition. We're nearing the end of the panel. Let's do one more round with like what's your main takeaways from all these various topics? What's the one thing the audience should remember going on and meeting us maybe later for a coffee to catch up the conversation?
So I would say not all staking is created equal. Be aware of differences. We need to focus on an industry education and clarifying definitions, and we will continue to see institutions develop and grow into staking. That definitely wasn't one thing, that was probably three, but I think that's that's the clearest summary of what I would like the members in the room to walk away today with in their minds.
Agree 100%, especially with what's happened in the last week with Kraken. I think we need more awareness, more education about how staking works. It's pretty complicated. We always struggle with explaining it, and especially when people are using the term for different things that aren't staking. I think maybe the thing to end on for me is Ethereum. Right now, if you look at Ethereum, approximately 14% of Ethereum is being staked. And that's low. If you look across other protocols, it's usually between 35 all the way up to 60%. The reason it's low is because the Shanghai upgrade is recent. For the last 3 years, there's been a lot of uncertainty with Ethereum unstaking, right? Like, who's going to stake their tokens if you don't know when you could get your tokens back? So that's been a huge barrier to entry. When Shanghai is released very soon, we'll see that number most likely rise from 14% to above 50%. And I think it will go up to 60% because institutions are so interested in Ethereum staking, and it's such a stable avenue for them.
Yes, thanks. For me, the staking is really the centerpiece of the proof-of-stake blockchains, where the economics and the technology touch, and that fuels all these additional layers on the blockchain and the applications that will happen. And we need good products where investors can participate in securing the blockchain and creating their share of the revenues in a compliant, safe, and usable manner. Thank you, everybody. Catch us at the coffee machine if you want to continue.
Thank
you.